All right. Okay, hello everyone, and welcome to episode 16 of STA Trading Views. I'm your host, Jim Toes, and thank you for listening in today. Trading Views is made possible by a grant from the STA Foundation, a 501c3 corporation that serves as STA's educational arm. As we approach the midpoint of 2022, we felt it was an ideal time to look back on some of the macro trends we saw earlier this year, while also looking forward to the remaining months of 2022. Much of the optimism and upward movement in stock prices that we experienced early in the year has dissipated and has been replaced with concerns on rising inflation and the increased speculation that we are heading into a recession. This has created an inflection point, which obviously is causing many global businesses to pivot. So the goal of this podcast is twofold. First, many of us have a narrow view or interest in the markets. We tend to be focused on either a particular sector or region of the world. Much of what we will be talking about with our presenter today is a global and international scope and view on things that are going on around the world, global trends that impact individual regions and individual sectors. Second, we're also hoping that all listeners come away with a greater appreciation of how capital flows across borders. At STA, we talk a lot about the efficiency within our marketplace with capital flowing across asset classes, equities, options, and futures, but seldom do we discuss how it moves with very little friction across the borders. So our presenter today is a senior executive at a global derivatives exchange. The perspective that he brings to today's topic is bona fide and will provide a view into the products and services that businesses around the world are seeking in order to effectively manage risk and achieve growth in a volatile global market. Our conversation will cover three areas: global growth, environmental portfolio products, and the options landscape. And if time allows, we also have a fourth topic that we'll be looking to cover as well. So with that, let me introduce today's presenter. Derek Sammann is a senior managing director and global head of commodities, options, and international markets at CME Group. CME Group is the world's leading derivatives marketplace. Through its exchanges, CME Group offers a wide range of global benchmark products across all major asset classes, including futures and options based on interest rates, equity indexes, foreign exchange, energy, agricultural products, and metals. Now, in his role, Derek is responsible for leading the development, execution, and management of CME Group's global commodities portfolio, including the energy, metals, and agricultural business lines. He also globally leads the company's cross-asset class options business and its growth strategy across international markets. And prior to joining CME, Derek acquired more than 16 years of sell-side trading experience in the global FX markets, including serving as managing director and global head of FX options and structured products at Credit Agricole. So with that, welcome, Derek, to today's Trading Views. Thanks for taking time out to be with us today. Why don't we start with the first one here, Derek? I mean, historically, most of our interviews, we usually start small and work towards the bigger topic. But, for our conversation, I thought it would make better sense to start big and talk about the international growth and demand. And then we can get into some of the driving forces. So tell us what you, CME, and other global derivatives exchanges are seeing in the area of global demand for global benchmark products.
Great, Jim. I appreciate the opportunity to connect. Always great to talk about what's going on in the global markets. And certainly at CME Group, we're a global exchange where significant portions of our business trades outside of U.S. trading hours from non-U.S. customer bases. From a personal note, I take global participation in markets very seriously. Personally, I spent 13 years of my own career as a market maker and a trader for a bank in the global FX markets between Paris and London. So global growth, global opportunities, and doing business from non-jurisdictions it's kind of always been, it's been my primary go-to source of business over the years. I came to the exchange in 2006, and we've seen nothing but significant non-U.S. participation in our markets over the last 16 years, certainly accelerated over the last couple of years. So you mentioned that the global connectedness of markets, and we see that across all of our asset classes at CME Group. So for STA members and those listening today, you're probably aware, as Jim, you mentioned before, CME Group is the leading global derivatives exchange offering benchmark products and futures and options across everything from fixed income, equities and foreign exchange on the financial product side, all the way through to energy, agricultural markets, and metals on the commodity side. We also run the two largest benchmark cash platforms in Cash FX, as well as cash treasuries. And over the last 10 years, really following Dodd-Frank, we also built out a robust swaps clearing capability to allow customers to offset their futures positions against OTC swaps, unleashing huge amounts of capital and operational efficiency. So when we think about the business we've seen, not just for the last quarter, but really for the last 3 or 4 years, our non-US business has been the fastest growing part of our business across our futures and options complex. Last year in 2021, we set an all-time record for our non-US business and transacting about 5.5 million contracts a day of the 20 million a day that we traded from outside the US. That's a significant achievement, but actually builds on multiple years of going from record year to record year of non-US growth. And this growth in different years has been driven by different asset classes. From 2017 to 2020, it was largely driven by our commodities portfolio, our energy business, metals business, agricultural products business. In a zero interest rate world, fixed income was growing slower than our other classes. And then in 2019, we saw a real pickup in our equities business with the launch of our micro futures that brought a whole new raft of non-US retail customers into our markets, trading contract sizes that were very well suited for their risk appetite. This past quarter, with the global upheaval, whether it was the war in Ukraine or commodity super cycle, we saw strength across every asset class in the first quarter of this year. So on the heels of yet another all-time record of non-US growth across the franchise in 2021, we followed that up with trading over 7.25 million contracts a day in just non-US business in first quarter of this year, and in midst of us doing about 24.5 million contracts a day overall of the exchange. So about 30 to 33% of our volume on any given day transacts outside US trading hours with non-US customers. And that's a mix of significant growth in retail participants in Europe and Asia and LATAM. But giving futures and options markets tend to be not just retail participation, but huge amounts of commercial and institutional participation. We're seeing really all client segments grow across asset classes. When we think about what the first quarter of this year looked like, and the non-US business particularly, it's interesting. Our European business had some different drivers from our Asian business, from our Latin business. But just to close out on this, what we saw in Europe particularly, overall European business first quarter this year was up 17%. And that was led by our equities business up 29%, and our agricultural products business up 18%. Slightly different mix of what we saw in Asia this first quarter, where overall the Asian business was up 22%. Energy was up 43% in first quarter of this year in Asia, followed by equity index up 33% and interest rates up 30%. So that's the benefits of running a multi-asset class exchange that provides benchmark liquidity in all 6 major asset classes, electronically, futures and options in all time zones, so that whatever's happening in a time zone at any hour of the day, any news report that comes out, customers can access our markets and interact. And understandably, Jim, our equities index complex is inextricably linked to the securities markets that many of your customers interact with every day as well. So we're seeing these markets very much be highly complementary and very well connected. So a lot of the themes that you're seeing on the securities side, we're seeing in our equity index side as well. And it's actually growing out into our equity futures and then retail participation in other asset classes as well. So it's a big story, a big source of growth for us, and something that we spend a lot of time putting growth and effort into, because that for many years now has been an outpacing source of growth and revenue for us over the years.
So we are going to talk, about retail participation later in our conversation here. But one area I did want to touch on maybe before that. I mean, some of the contributing factors that you kind of highlighted that contributed to the demand for, the products were, geopolitical in nature, geopolitical events that are occurring around the globe, creating demands for certain products. But there is another, driving factor out there, and that is that the E and ESG is certainly a global issue now, right? And businesses obviously are looking to develop a comprehensive strategy around ESG, in particular the E part. So maybe you could just spend some time explaining what CME, the portfolio that you have of environmental products, and tell us which ones are in most demand, and what are you kind of expecting in the short to medium term from this portfolio?
Yeah, it's a great question. And ESG is dominating lots of corporate boardroom discussion times right now, whether you're a public company, a private company, family-owned company. Everyone's trying to figure out what ESG means for them, whether it's on the social side, the governance side, or to the point you just made, Jim, we really focus most of our time and effort on the environmental piece of that. And we actually have two flavors of pieces of that. On one side, we have an explicit set of ESG tradable products in the form of our equity indices, our ESG indices, and those have seen tremendous growth and very, very strong growth in open interest holdings over the last couple of years. So if customers are looking for ESG compliant investments, then we have a lot of customers that are increasingly using our ESG indices. But where we focus a lot of our time, and increasingly so in light of the E of ESG, to your point, is how we're building out portfolios of products for customers to manage their environmental risk in a world that is going through pretty significant transition and birthing pains of what it means to convert over a multi-year basis from a historically fossil fuel driven agenda to renewables or non-fossil fuels. That's not a change that happens overnight. And already in fossil fuel markets, there's significant risk being managed in CME. We're the largest energy exchange out there between our fossil fuels business of our crude oil markets or our natural gas markets or biodiesel or anything else. But what we're seeing, to your point, is now the demand for transition products, and as markets move away from pure fossil fuels into either transition fuels like natural gas or biofuels, or all the way through into component parts of the EV manufacturing process, like battery metals, cobalt and lithium, for example. Part and parcel of all of that is, we work with our global customers and market participants to build products that work for them, that manage specific parts of the risk in their front to back, their physical supply chains, or risk that they're seeing growing in their markets. So we've developed a whole suite of environmental products that we manage as a portfolio, because the lines between agricultural products and corn and ethanol is bleeding into energy markets, ethanol being a fuel, but the source being corn, soybean oil is being caught up in that as well. And the blurring then of line of distinction between energy and metals, now between battery metals, which is actually driving the EV growth as well. So we're seeing, blurring lines of distinction between asset classes. And so we built out this environmental products portfolio that has everything, as I said, from biofuels all the way through to battery metals. One of the most interesting parts of this market that's growing up literally before our eyes is the carbon offset market. You hear a lot about this and a lot of need to say, well, people don't believe that there's going to be a binary outcome that says today we're using fossil fuels and tomorrow we won't. So this is a transition. So most folks are looking at, how do you manage that risk, manage the pricing of managing your carbon footprint? How do you monetize that? How do you offset that risk? And so working with our global participants, we've developed a suite of products in the voluntary carbon emissions markets that we call our GEO complex, which is global emissions offsets. These are futures that link to specific amounts of CO2 reduction. Every one of these contracts has a face value of 1,000 tons of carbon offsets. And we've launched these contracts going back to March of 2021. We now have 3 products in our GEO portfolio. And we are very proud to say that our customers have now traded in excess of 100 million metric tons of carbon offsets. These are customers that are either energy producers or metals producers that either in their production process are very carbon intensive. So to meet their carbon neutral commitments, they are using our global emissions offsets futures contracts to purchase offsets for the carbon they're emitting. And they are then purchasing those offsets that are secured and validated by global registries under the United Nations. There are 7 global registries that validate these projects. They get validated and traded in the spot market on a platform called CBL Expansive. And then we are the exclusive provider of the futures market for these products as well. So it's a fascinating part of the business. It's growing rapidly. About 70% of the participation in these markets right now are commercial customers, 30% financial players, asset managers, hedge funds, proprietary trading firms. This hasn't yet become a market where there's any real discernible retail participation in over time, but we'll see as the market evolves and grows. We certainly think that these products, based on the adoption we've seen already, we think have already established themselves as a vital part of the energy transition story that we're all living through right now, but also a vital part of any corporate treasurer's toolkit for managing the increasingly set of ESG risks. And this one's specifically focused on the environmental piece. So fascinating time, very strong growth. Early days. This market's only really been around on the voluntary credit market side, voluntary carbon market side, I should say, for about the last 2.5 years. But we're building our futures markets in real time alongside the spot market. And we're seeing global participation in a really, really positive and I'd say scalable way. So we're excited about what this turns into.
I can tell you, you brought up a really good point. I mean, I think there is a much higher degree of appreciation and understanding how the ag market, the energy market, and the metals market now are the influence and that they have upon each other. I mean, I know we talk a lot about the price of gasoline and filling up at the pump, but little is really talked about the price of diesel and how that has a direct impact on the farming industry and obviously that on our food prices. So it is. It's funny, we look at the world from blurring lines between equities, options, and futures, and now there's this other world in commodities that there is this blurring line between the impact in ag, and energy, and metals on it. So thank you for making that point. Listen, you talked a lot about it in this area around these environmental portfolio products, so they're mostly this institutional large entities that are participating and buying these products, and there is not much of a retail participation in it. There are areas, obviously, within CME, within other areas here, within the derivatives futures marketplaces, where retail is able to have access and speculate and also protect their portfolios on. So maybe you could spend some time maybe on the first part, and that's around options. Tell us some of the things that you're seeing. What sort of options does CME offer? What's been your experience with them, the growth, and where do you see this playing into the to the larger picture?
Yeah, and I'll maybe pause right there on retail initially, and then get into the options piece. I would say absolutely, retail has always been an important part of our futures market. We're seeing the discount brokers and the retail brokers out there continue to onboard increasing numbers of futures accounts for retail customers. When you look at what we've done to accommodate the needs of retail traders, because we have, again, a huge amount of institutional business and commercial business, but understanding the power and the access to multi-asset class growth. I mean, look, one of the key themes we've seen in the last 2 years has been the commodity super cycle. There's no better way to play the commodities super cycle, whether you're looking for the increase in price of wheat that's almost doubled, copper, any of the energy products. There's no better way to access that than getting access directly into the futures markets, where we are the primary market pricing mechanism for each of these asset classes. So what we've done is recognizing our own existing retail client base and the growing need for access to smaller retail size contracts. We've significantly expanded our suite of what we call our micro futures contracts that, for the most part, cross asset classes are futures contracts that are 1/10 the size of our institutional contracts, and they have been a phenomenal success. We actually launched our first micro contract back in 2010 in our precious metals business back over 12 years ago, and they did a decent job, and there's always been retail participation in precious metals. But what really accelerated growth of our micro product suite was when we launched micros in equities back in 2019. And when I just look at the most recent trading data from first quarter of this year, we had over 1.5 million contracts a day traded with retail customers, 275,000 retail accounts actively trading this quarter. And when you look at the micro contracts overall, we had just about 4 million contracts of micros trade every day on the CME. Again, you consider that we did 24 million contracts a day in the first quarter. That's a big chunk of our business. That's been an increasing part of our growth story, and their products that, again, having started in metals, they really took off under equities. Given the success that we've seen and given some of the supply chain concerns that we saw in energy last year, we decided to launch a micro WTI contract. WTI is West Texas Intermediate. It's the benchmark crude oil contract globally. So we launched a micro crude oil contract in July of last year, and that contract is already trading over 150,000 contracts a day, and that's largely participation from retail. So when you've seen the asset inflation that we've seen that's driving much of our global inflation right now. A lot of that is input driven. That's largely driven by crude oil, diesel, as you just mentioned, natural gas. So giving customers access to one of the key drivers of core inflation, energy, in the form of micro products has been a real success story. And it's been really a function of our partnership with our broker partners and their communication and what they're hearing from their retail participants saying, wow, I'd love to play directly in the energy market and be able to strip out and manage core inflation risk. But without access to a retail size contract, it's hard to do. So we've answered that call. We're going to be launching later this year, I think in June, a gasoline, micro gasoline contract. As RBOB is the term for a gasoline future, as well as natural gas. And we already have a micro copper contract as well. So for retail customers looking to gain ways to manage exposure to or get exposure to the commodity super cycle, these are great products to get access to and continue to be a big part of our overall growth story of our retail growth overall.
You mentioned partnership with your brokers and your the broker dealers, and I'm curious, like, do you think, what is it are you hearing from them as far as the attraction for these products? Is it their ability to be traded outside U.S. trading hours? Is that one of the attractions on it? Because some of these you kind of mentioned, there are investors do have other ways of getting that type of exposure in their portfolio away from these products, but it does seem, to your point, you talked about 24 million contracts, I think it was, for the last quarter. I'm just curious, like, how much of that is really, or occurs like outside of U.S. hours? Because that definitely seems to be a trend that we're seeing on our side from the broker dealers having to satisfy that demand with their clients. Their clients are, who are just expecting to log on at 9 o'clock at night and be able to do a trade.
Yeah. No, listen, you're right. We're increasingly living in global markets. And I think we're seeing not only geographies connecting, but we're seeing news cycles in different geographies directly impacting markets outside of that particular geography as well. So customers, to your point, expect at any point in time to be able to have a front-end system on their phone, on their watch, on their laptop, on their iPad to be able to enter and exit transactions. And that's absolutely critical. The key lever of growth for us globally, and to reorient the listeners to what that represents, we did roughly 24 million contracts a day in first quarter of this year. We did over 7.25 million contracts outside of the US hours. So again, you're talking about, roughly a third of our business that's transacted outside of hours, and it's between 30 and 35%. Some asset classes higher. FX and metals tend to be higher proportions of non-US business. On our global benchmarks, which tend to be our energy business, our ag business, our metals business, those global benchmarks tend to trade even higher percentages overall. FX is close to 50%, for example, as is metals. When you look at our U.S. fixed income business, we are the market for global or for U.S. fixed income, and on the future side, we are the market for U.S. equities. And given that those are, yes, U.S. markers, but those are really global benchmarks in and of themselves, because a lot of non-U.S. participants want to trade in the U.S. benchmarks or the global benchmarks. So they expect to log on at, starting 4:30 p.m. Chicago time today. They're going to be trading all the way through till 4 o'clock the following global trading day. So we have global access, lit screens, futures and options all day long, and an increasing percent of that business, as I mentioned before, is taking place outside the U.S. And here's the really fun fact of this whole thing. We're going to talk about options in just a minute. We're seeing even accelerated growth of not only options versus futures, but non-U.S. options versus U.S. traded hours futures. It's just the ways in which, our global customers and market participants, whether in the security side or the futures side, are increasing their levels of sophistication is shining no more brightly than in our own futures and options franchise and what we're seeing from outside the U.S. And the numbers are astounding. If you look at the growth that we saw, even just first quarter of this year, we saw Europe options growth up almost 30%, APAC up almost 35%, and our LATAM business up 78%. So these are customers that want to be in global benchmarks or the benchmark US markets, and they want to trade during their time zone on lit markets in futures and options. That's what the client demands. Jim, that's what we got to deliver. So that's what we spend our time doing. And technology has been our main driver for that.
So let me see if I can say, you said non-US options on US options on futures. Did I say that correctly?
Yeah, we call them options on futures. We just call them options generally because they all are underlying the underlying futures themselves.
Okay, great. Is there any other remarks you want to talk about on options? I just, otherwise we can kind of, wrap it up here. Is there anything else you want to talk about? I mean, obviously options are huge. I mean, what a story on this, for the past couple of years, with retail investing kind of, taking on, going on to apps and the ability for them to, trade for free on it. It's been such a great growth story for the industry. Do you feel like, did I give you enough chance to talk about options
Yeah, I think you're right. And probably the one other observation I'd make, and this is, data driven as well
right,
as anecdotally what we hear from our channel partners as well as underlying customers themselves is that sticking with the options theme, options are becoming a bigger proportion of almost every customer's toolkit and how they're managing their risk or how they're gaining exposure to risk. So for example, when I mentioned how well we did in the first quarter of this year, we actually saw our futures business cross asset class up 16%, but our options business was up 32%. So our options business grew twice as fast as our futures business. Again, our options are based on our underlying futures, so they're obviously connected markets. But we're seeing, and the point in showing that is that both futures and options are growing. But options are becoming a bigger percent of not just the volume that's traded on our exchange every day, but of the open interest as well. So that confirms what we're hearing from our customers anecdotally. What we're hearing from our channel partners and our broker partners is that there is an increasing level of sophistication where customers, particularly in the volatile markets, in some cases some discontinuous markets, that options are a spectacularly flexible way and a very efficient way to play markets in high volatility and where you have even some gaps in markets that are just moving around as aggressively as they are. So when we look across some of the options business, as I said, when you take an asset class cut of that options growth in first quarter, our equity options business, near and dear to the listeners here and to your members, was up 81%. I'll say that again. Our equity options on futures business up 81%. Rates was up 23%. FX up 22%. Energy, metals, and ags were up between 8 and 15% respectively. So you're talking about not only volumes and options outpacing underlying futures in volume terms, it's also a larger percent of open interest, meaning more customers are carrying more risk in the form of options. That's giving them a level of flexibility and frankly, operational capability that in markets like this is very well suited. So kind of ties together the global piece, the options piece, the retail piece, all into kind of one overall stat. But it's been a fascinating time. I've been in this business 32 years. I've never seen markets like we've seen for the last quarter. I don't know anybody that's been in this business that hasn't been able to say the same thing. This is a point in time when it's critical now more than ever to listen to our customers, work with our channel partners, understand what their needs are, give them the technology solutions they need so they can manage their risk in very uncertain times that I frankly don't think we're going to see a lot of certainty in this market for quite a while. So we're in this for the long haul, serving customer needs, connecting with all of these complementary markets. And I think the customer wins as a result of having, lots of different ways to express their risk.
I mean, listen, options, I mean, the amount of education that the industry is providing to investors in options is definitely another contributing factor, to its growth, besides just the nature of the fungibility of the product itself, where it can, it can truly go across asset classes as well as a product. So listen, I think it's a great place to kind of leave our conversation on this. I just want to thank you for coming on and sharing your thoughts with STA members and everyone else who's listening in on this thing. We wish you nothing but success here. And like you said, I think we are, what we are living in today, we're going to be living in it for quite some time. So I think it is probably in everyone's best interest to kind of understand some of the macro trends that you kind of touched on today. So thank you again for joining us.
Well, I appreciate it, Jim. I appreciate all you're doing for your customers and your constituents. And as I said, getting more people involved in markets and raising level of understanding, helping them manage their risk better and giving them all the tools they need. The work that you guys do to enable that is a hugely important part of the evolution of these markets as we get better and help our customers and our constituents be in the best position, no matter what kind of market conditions they're facing. So I appreciate the work we do. We appreciate the partnership with you and look forward to talking again.
Yes, in person.
Hopefully.